Should hedge funds be banned from buying houses? Hey guys, it's Brad from probatehouseguy.com. I am the Probate House Guy. Check out my YouTube channel and also go check out the Probate House Guy podcast, available on all the podcast platforms. I'm a real estate investor. I specialize in the world of probate and inheritance properties, but I have been investing in real estate now. In a couple weeks is going to be my 8-year anniversary of buying houses. I've bought hundreds of houses, flipped them, wholesaled them, rental properties. I'm also a licensed agent. I've been a licensed real estate agent where I live in the state of Georgia since 2017. And I've seen it all, right? And I'm a part of a national real estate mastermind group. And today I want to talk about hedge funds. And that's kind of a controversial topic a little bit. A lot of, at least locally here, there's been a lot of sort of talk about, these hedge funds own all of these properties and they're pushing out, they're squishing out, first-time home buyers, and they're, taking over the market and they own everything and blah, blah, blah. You know how the media does. The media is just hyperbole. They want to, controversial headlines get views, and that's all they care about. And maybe I'm doing these videos to get views, right? Imagine that, the irony of that. But hedge funds. I know a thing or two about hedge funds because I have worked with a lot of hedge funds over the last few years. I have sold properties to hedge funds, whether that's me being an agent or me wholesaling properties to hedge funds. What most people don't realize is that hedge funds don't buy properties direct from sellers. Typically, a hedge fund is going to buy a property either that's listed on the MLS through a real estate broker, or they're going to buy off-market properties they have an acquisitions team that basically networks with wholesalers and real estate agents to buy off-market deals. That's how hedge funds acquire their properties. Also, some of them buy at the foreclosure auctions, although that's not really a thing anymore. There's not that much inventory on foreclosure auctions anymore. There still is inventory, but it's not like it used to be. And a lot of the hedge funds actually started back in, I would say, between 2011 to 2013 is when they started buying up properties, and they were buying up properties on the courthouse steps. That's where a lot of them got started. They started buying properties on a large scale, and they basically cleared out all of that foreclosure inventory that was sitting on the courthouse steps very quickly over the span of like a couple years. And that all kind of happened like right when I first got started in the business, back in, it was really like 2014 is when I got interested in investment real estate. 2015, I started making offers and trying to buy houses, but I wasn't successful in buying my first deal until 2016. Those hedge funds at that time were just clearing out because I remember when I first got started in 2015, I was trying to buy stuff through the foreclosure auctions and from REOs, and I was losing out on deals left and right. People were overbidding me, and I'm like, how are they paying this much for properties? Doesn't make sense. Well, that was hedge funds beating you out in the deals. That's when they got their start. And then they realized that once they cleared out the inventory in the auctions, they still needed they had all this investor capital that they had raised, and they needed to deploy this capital and buy more properties. So that's when they started creating acquisitions teams where they were networking with wholesalers and with real estate agents and trying to find off-market deals. And it was very successful for them. Now, I will say early on, a lot of the hedge fund offers were okay. But after COVID, when the market went like crazy, that's when hedge funds were buying up like ridiculous amounts of properties. 2021, late 2020, all of 2021, and through about the middle of 2022 was like the heyday for hedge funds. They were buying properties like crazy, and they were paying stupid, ridiculous prices. And that was because it was like pandemonium in the real estate market. Like that was multiple offers on everything and da-da-da. But what I want to talk about here is there is some truth in that hedge funds were beating people out on offers. That's absolutely true. Now, what I will say, and don't take this as me defending hedge funds at all, hedge funds have a very narrow buy box, as they say. They only buy very specific properties. Now, a lot of those properties are kind of first-time home buyer, starter homes. They don't like to buy older homes. A lot of the there are some that buy older than that, but many hedge funds like things that are like 1980s construction and newer. Some of them are even 1990s and newer. A lot of them only buy in specific school systems. They only want, desirable school systems. A lot of them, have a 3-bedroom minimum. They won't buy anything less than 3 bedrooms. A lot of them have a 4-bedroom cap, so they buy between 3 and 4 bedrooms. They won't buy 5-bedroom houses. A lot of them won't buy houses that are on septic systems. It has to be on a public sewer. Now, there are exceptions to this. There are some who buy on septic, but in many cases, they want to buy on public sewer. They want to buy on public water. They won't buy houses in HOAs that have rental restrictions. They won't buy houses in townhouses. They don't buy townhouses. It has to be like a single family detached rental. There again, like I said, there are exceptions to some of these, but I'm speaking in general, generalizing most hedge funds together here. They have specific purchase criteria. They call that a buy box, right? And they also have specific returns on basically cap rates that they buy at, a capitalization rate, or it's basically the return on investment. Based on they to look at what the gross rents are, and then they have a gross rent multiplier. So if the gross rents are X, they'll only pay X amount all in for the property. So if the property rents for, let's say $3,000 a month, and they have a desired gross yield of 10%, then you do the math there. Their all-in purchase price has to be basically give them a 10% gross yield on whatever the rents. That tells you what they'll buy. And if there's any rehab in there, you've got to deduct from that. So that's how a lot of them evaluate these properties. And then they also have the tack on broker commissions and all that. I sold a lot of properties to a lot of hedge funds in 2021 to late 2020, 2021, and to early 2022. But what happened in 2022 when the interest rates started going up? Well, that blew up the business model of the hedge fund. Most of the hedge funds, it blew up their business model overnight. How they were making money didn't work anymore. So let me explain to you how most of these hedge funds that buy single-family real estate really make their money. Okay, they raise money on Wall Street or wherever through PPMs, private placement memorandums. They raise money, and then they have this big pile of money, and they have to go buy single-family houses. They tell their investors, we're only buying specific types of houses. The buy box, right? Their buy box is, we only buy this. We only buy this, right? So their investors that are investing their hard-earned money into this fund know what assets this fund is buying. So they take the money they raise, they buy all these single-family houses. They may do some repairs to them. Maybe some of them they don't have to do repairs. They put tenants in them and they get them rented and producing income, okay? Now that they're producing income, and they've owned them for a seasoning period, the hedge funds actually go to a bank, like a large bank. Depending on the size of them, might be a regional bank, might be a big bank. Some of the big hedge funds like, Invitation Homes are going to like Deutsche Bank, like big international banks, and they are borrowing money against their real estate portfolio that they own, just like a small mom and pop investor does, like myself. I go borrow money from a bank and collateralize my properties to borrow money to recapture some of my cash. And I make sure, and they do the same thing, I make sure that once I borrow the money, I know that my payments to the bank are going to be X every single month. If I'm still cash flowing and still making money after I borrow the money, then all that cash I take out is like free money because it's not taxable, because it's debt. It's not real income. Then I can take that cash and use that cash to buy more real estate, invest in other things. That's the same thing that the hedge funds do. So they go buy all these houses, and then they borrow money at the time, way back when, a few years ago, they were borrowing money at ridiculously cheap interest rates, like really, really cheap. Let's say they were promising their investors 7% return on their money. So they borrow money, they're promising 7% to their investors. They get this portfolio, they rent it all out. It's making decent money, right? It's not like crazy home run money, but it's like pretty decent, steady, predictable income. And then they go to the bank and they take some money out of that portfolio. Let's say the bank gives them 50 cents on the dollar. So let's say they own, $10 million worth of real estate. They go back and the bank gives them $5 million, lets them borrow $5 million against their $10 million real estate portfolio. And then what do they do with the $5 million? They take that $5 million and they go invest that money into higher yielding asset classes, more volatile asset classes, things that are, giving them 15%, 20% returns on their money. So you say, Brad, well, what happens if they lose all that money? Well, if they lose all that money, they're still okay. They still have that underlying real estate portfolio that's still performing. They can still pay their investors the 7% return that they promised them. They can still make the debt payments to the bank on the money that they borrowed, and they still make a little bit of money at the end of the day, and all is good. So what happened in 2022? Well, in 2022, the Fed funds rate started going up. All the interest rates, the central bank rates, and all that started shooting up. Well, now what happened? They couldn't go back and borrow money at stupid cheap interest rates anymore against their portfolio. So now all of a sudden the math didn't math anymore. They couldn't go borrow money against these real estate portfolios and reinvest that capital into higher yielding stuff and make more money. So then all of a sudden, all they were left with was a mediocre performing real estate portfolio. It's safe, right? It's a good, safe portfolio. It makes money. It's real estate. The values, even in the 08 crash in the US, we saw anywhere from 20 to 30% declines in real estate value. Some markets saw worse than that, but for the most part, on average, between a 20 to 30% decline in the real estate values in there. Well, think about that. That means it still retains 70% of its original value. It lost money, yeah, but then it came back. So from their perspective, it's a good, safe investment to invest in single-family homes. So that's why they did it. They invested in these single-family homes, and they went and took that money, and they partied with it, let's say, and put it in higher-yielding stuff, and they were making killer returns on that recapitalized money. And then the clock stopped, the music stopped in late 2022. In fall of 2022, a lot of the hedge funds that I was working with for years literally closed up shop overnight. They all stopped. A lot of them said, hey, we're pausing acquisitions. And then the pauses became permanent. And then before you know it, nobody was buying properties anymore. And then in January of 2023 or Q1 of 2023, as things stabilized, let's say, they decided that some of them decided they were going to start buying again because they still they had this money from their investors that they still had to deploy and still had to buy properties. But when they got back in and they started dipping their toes back in the water, they started being very, very selective about what they were buying. And they quickly raised their desired yields to the point where, like, if I was pitching a deal to a hedge fund, their offers just didn't make any sense anymore. Like, I was looking at their numbers and looking at their offers, and it's like, I'm better off keeping this property myself, rehabbing it, flipping it, and selling it retail because the retail market's still pretty strong. I can just sell it retail or keep it for myself. Their enticing offers that they were making before just didn't make sense to me anymore, so I didn't sell properties to them anymore. So all of a sudden, all these hedge funds that were buying up like ridiculous amounts of houses are now buying like a fraction of the homes that they used to buy. Like, they've laid off entire acquisitions teams. I know a lot of guys. Actually, I got a phone call the other day from a guy that I know who is a friend of a good friend of mine that I grew up with. And he was in acquisitions for multiple different hedge funds. And he called me the other day and he said, hey, look, man, I've been looking for a while. I can't find a job. No one will hire me. None of the acquisition, all the funds have closed up shop. I've only worked for hedge funds for for the last X number of years. This is all I know. I don't think this is my future in real estate. Help me do real estate on my own. And he asked me to just help him out. And I said, sure, yeah, no problem. I mean, people helped me get started, so I'm going to help him get started, right? I'm just paying it forward, right? And he's a friend of a friend, so I'm going to help him out a little bit, right? And so, but he can't find a job because acquisitions are dead for like all these funds, right? So the funds that are still buying today are not buying at what they were buying, and they're buying at a tiny fraction of the rate that they were buying before. They're just not buying. And like I said, a lot of these hedge funds have closed up shop. All right, so let's dive into, should we stop them from buying houses? And my answer to that is, well, I don't think you need to anymore. I think you're a little late to the party because they've kind of already stopped buying houses. Unless things change with interest rates and interest rates drop back down into the stupid free money, cheap percentage range, you're just not going to see hedge funds like they were before because the market conditions for them to thrive just don't exist anymore. And even if rates drop a little bit, that's not enough for their business model to make sense. So they're looking into other asset classes. So what are some of these funds doing? First of all, because inventory was really, really low, and it has been low for over a year now. That's why you're seeing these build to rent communities. So you may see neighborhoods where all of the houses are owned by a hedge fund. They're building entire neighborhoods because they have capital they have to deploy and they have to buy to keep their investors happy. And they can't buy, used single family homes anymore. Their only choice is to build a brand new house. Now, there is some positives about building a brand new house from their standpoint, is that your capital expenditures are, far down the road because you got a brand new house. Everything's brand new. So you don't have to spend money on capital expenditures for a long time. So they're looking into those models. That's why you're seeing these neighborhoods pop up that are all hedge fund owned and they're all just rentals. The beauty about those neighborhoods too, from their perspective, is eventually, if they want to start selling these homes as single family homes for families to buy in the future, they can. Like, these are normal houses, normal neighborhoods. Like, they're the same as everything else around them. They can just, if they wanted to sell them out, eventually they could just sell them individually, right? So that's the benefit of that compared to like a multifamily property where you've got a whole apartment complex where you can really only sell it to an investor because it's a commercial asset. You can't sell the individual apartment. Well, you can if you do a condo conversion. You can split the apartments up into condos and sell them as condos, but that was something that happened in the early 2000s, but that's not really much of a thing anymore. And let's also talk about, so from the legislation perspective, restricting them, I don't think is going to do any good. And this is just my opinion, right? If you restrict the number of houses that an investor can own, all they're going to do is set up multiple entities and only own 10 houses in each LLC. And then they're going to end up with 100 LLCs with 10 houses in them. Like, you're not going to stop them from that perspective. The reason that they're buying and the reason that they're doing this is because the business model makes sense and the numbers work. If the numbers don't work, they don't do it. It's just like me. When I buy a house, I look at the numbers, and if the numbers work, I buy it. If the numbers don't work, I don't buy it. It's as simple as that. It's just a math problem. That's all. And I think the reason the funds stop buying is because the math doesn't work anymore, and that's why they're not buying anymore. So I don't think you need to restrict them. And then if you do create restrictions, guys, let's look at legislation. We all know this. Congress passes laws, and half the time, the person that's writing the law in Congress really has no idea how that thing really, really works. And they create this law that has a whole bunch of unintended consequences that comes with it because they don't really have an understanding about all of the intricacies of how that whole system works, and they end up doing more harm than good. And I'm afraid, look, the intentions of doing this are great. I think that there's a lot of unintended consequences that will come along with that, and I think you're going to create a bigger animal, and it's going to do the opposite of what you want. Like, look at rent control. Rent control does the complete opposite of what people want it to do. It makes less houses available to people, so then the housing stock gets crappier and crappier and crappier because the landlords that own the rental properties are just going to hang on because due to rent control, they can't sell their asset because no one wants to buy assets in that area because of the rent control. So then slowly the inventory goes down as investors retire. Again, they can't sell their rent control house to another investor, so they end up just selling that property to an owner occupant. So then the available number of rentals gets smaller and smaller and smaller and smaller over time. And what happens as supply decreases and demand increases? Demand will always increase because population continues to increase. Prices. Well, at some point, your price fixing doesn't work anymore. You can't fix the prices anymore because the laws of supply and demand say otherwise. So I don't think that that's a good solution. Also, don't believe everything you hear in the news. For example, the Atlanta MSA probably has one of the highest, if not the highest percentage of hedge fund owned properties in the country. But let me break these numbers down for you real quick. In the Atlanta MSA, the Metro Statistical Area of Atlanta, which encompasses like a lot of counties. It goes as far north as Pickens County and all the way down to like Meriwether County, all the way out to the Alabama border and all the way out almost to Athens. That's the Atlanta MSA. The Atlanta MSA has roughly 1.4 million single-family residences in the Atlanta MSA. If you look at any LLC or any property that's owned in a legal entity, whether that's an LLC, partnership, incorporated, whatever, there are roughly 12% of the single-family residences in the Atlanta MSA are owned by some sort of legal entity. Now, mind you, that could be like me. I have one LLC where I have one property in that LLC because I did a partnership deal with a friend. So like my one rental property that's in the only one in that LLC will show up in those numbers. Or the mom and pop guy that maybe the husband and wife set up an LLC and they own 2 or 3 rental properties and that's it. And they both work full-time jobs and they just own these rental properties on the side. That's going to show up in those numbers too. So now let's split out those numbers into people who own 2 or more properties. If you break that number, and I pulled all this data from CoreLogic, 2 or more properties cuts that number down to 8%. So someone who owns 2 or more properties in the Atlanta MSA, a corporation, a legal entity that owns 2 or more properties, mind you, that's still mom and pop landlords that maybe own 2 or 3 or 4, maybe they own 10 rental properties. A lot of people, like if you get 10 paid for rental properties, you can pretty much kind of retire off of that if they're paid for. They'll cash flow enough income where you can live comfortably off of that. So that's not hedge fund territory. That's not big corporations owning. That's like mom and pop people like you and me that own properties still show up in this 8% number. I don't have the facts about drilling it down even further. I think that number is going to be very small and you're going to be very surprised. Also, in the news, I was reading one of the articles. They said, between Progress Residential, Invitation Homes, and Amherst Holdings, which is Main Street Renewal, in Atlanta, they own 19,000 homes in Atlanta. There's one more. There's American Homes for Rent, and there's a few more hedge funds that actually operate in Atlanta, so they missed out on the numbers. But 19,000 divided by 1.4 million is only 1.3%. So those 3 companies only own 1.3% of the homes in America, or in the Atlanta MSA. And let's backtrack to any legal entity, any property owned by a legal entity, right? Whether it's 1 or more, it's only 12%, which means that you have 88% of the properties in the Atlanta MSA that are not owned by a legal entity, right? So that's the breakdown on the numbers there with hedge funds. If there's going to be any legislation into hedge funds, I think the legislation should target how the property management aspect and how they treat their tenants. And I'm not going to get into it in this video, but I will tell you that my wife and I, back in 2021, we sold our primary residence because we wanted to build a new house. And we sold our house to cash out all the equity to use it to fund this build, to build this new house. I'm actually in the house right now. This is my studio in my house. We rented a house from Invitation Homes, and it was a terrible experience. And I could make a whole video about how terrible that experience was with Invitation Homes. I'm not going to do it in this video, but if there's going to be any legislation against hedge funds, they should really look into the landlord-tenant law aspect and how these hedge funds are skirting the rules a little bit and abusing things. So I would definitely, if I were going to see any legislation, I would want to see it from that standpoint. But again, I'm a libertarian. Like, I don't like to see a lot of government interference. I like minimal government because government comes with a lot of unintended consequences. And I'm not a pure libertarian. So if you're going to start spamming me about how libertarians are wrong, I lean more libertarian in my views, right? Live and let live, okay? Less government. Let me decide how I should live my life, and you can decide how you live your life, and everybody's good. That's my political standpoint. So That's where I'm coming from with a lot of these messages and why I don't think there should be legislation against this, because they will inevitably find a way around it. So I know this was a long video, but it's a very controversial topic and I felt like I needed to talk about it. So I hope you enjoyed it. This is Brad from Probate House Guy. Go check out the Probate House Guy podcast. Go to probatehousiguy.com if you want to learn more about working with me and what I do. Thanks for checking out this video. Hope you have a great day. Bye-bye.